Well, what's going on, guys? Welcome back for another episode here of Let It Grow Investing. I'm Jeff, and we got another good one for you here today. So, what do we want to cover? We want to cover all things stocks. We want to really focus on building that right portfolio, a little bit depending on your age, and also trying to just get that balance right. I see a lot of people questioning, should I buy this stock? Should I buy that stock? Why are we in one? Why do I buy one versus another? And really how you want to set yourself up for success going forward. I also want to look at the opportunity cost of buying one stock versus another. And so we're going to talk about a little bit of that before we get into some single stock news. I kind of got into this as a single stock investor. And is that right for everyone? I'll say probably not for everyone, right? It's not for everyone. You got to, buy a stock and do a lot of homework. You got to keep up with what they're doing, what they're building, what they're buying. Is the growth right? Is the revenue good? Are the margins good? Is there a slowdown in this space, but an acceleration in that one? There's just so much to keep up with, and it really can be a full-time job. So I really want people to think about that before you simply just get into buying a single stock. So with all that said, please make sure you like, subscribe, and share. It really does help the podcast grow. Helps me out, and there's links in the description to help get you started. E-Trade, Webull, crypto.com, things like that. So, and we've actually had some Bitcoin rally here lately too. So we've kind of talked about that before as well. So we'll get into that, right? So I've talked before. We've said that if you are starting your first 10,000 be in a total market ETF, right? An ETF is an exchange traded fund. Basically, you put all these stocks into one basket. That's not even stock related, but it's just kind of forming teams, and they're all individual. This is the team on each field, right? So which basket do you want to fill? So that is kind of what I'm looking at here, right? If you want growth, right, you need to think about, well, how much growth do I want? And then how much of that total market do I want? So that first 10 grand, I really like the fact that you're putting it into an ETF that covers all of the market, right? I'm thinking VOO or something that mimics what the SPY does, the S&P 500. So that is something that I really try to advocate for anymore. I didn't start that way. My portfolio looks that way now because I didn't start the way that I would have started had I listened to myself, my future self, when I was getting going like 12 years ago at this point. Bitcoin is at 77.8. Over the last week, Bitcoin is up 21.9%. So doing decent. And I said, under 100, I said I was waiting for 80. And then I said I was trying to average in the 60s and the 70s. So again, there's opportunity cost of not knowing when something's going to turn around. So we'll talk about that a little bit. So if you're looking at getting started, I'm going to go ahead and share my E-Trade, where this is actually Tesla, but we'll get there. We'll navigate there together. So if we're looking at VOO, I think this is a good spot to park. I mean, you could potentially put all your money here. Would I do it? I wouldn't, but let's take a look as to why you could, right? Well, you're looking at the 500 best stocks, arguably the 500 best stocks, most balanced stocks in the market. Are you getting all tech? No. Are you getting all healthcare? No. Are you getting a mixture of all these different investing styles? Yes, right? Some of them, the banks are going to be lower PE. You're going to get stocks with higher margin, higher return. There's a lot of different things to think of when it comes to this investing basket, if you will. So when you are buying one share of VOO, which on E-Trade, my link is in the description, you can buy fractional shares now. So you don't have to come in with $703.71 to buy one share. You could simply buy $100 a week. You could also do that on Webull. So if you have $100 or say, hey, every time I buy a coffee at Starbucks, I'm going to invest the same amount into Starbucks stock or into the VOO or into SPY or SPYG or whatever it is that you're trying to build a position in. So again, opportunity cost of buying this stock versus that stock, and also opportunity cost of spending your money on coffee or spending your money on new shoes versus putting your money into maybe the stock that corresponds with where you bought the shoes or where you bought the coffee, right? So there's a lot of different opportunity costs. So what does it represent when you're buying, a share of VOO? That's a question that a lot of people want to figure out. Like, what am I buying? What is this? And where's my money going? Well, 37.6% of your money that you're putting into VOO. So for every $100, you're getting about $7.50 of NVIDIA, right? You're getting $7 of Apple, about $5.35 of Microsoft, and so on, right? So this is just the top 10. It represents 37% of the assets in VOO. Now, why is it so heavy on tech? Well, tech keeps growing. So these stocks represent more because of the fact that they keep taking up a bigger share into the S&P. You could get an equal weighted S&P 500 to where every dollar that goes in represents, or every 100 that goes in is split up evenly amongst those 500 different shares. I'm trying to look up equal weight S&P 500 ETF. That's what I'm doing on Google over here to the side. Standard S&P 500 would be SPY or VOO. We talked about that. Equal weight S&P 500 would be RSP. So it gives small and mid-sized companies in the index. They matter just as much as the larger tech giants. So if we look at that, we will see that it's more evenly distributed fund, right? You're not putting as much into NVIDIA or Apple, Microsoft, Meta, Google, Broadcom, JP Morgan, right? We're looking to see how we can to do this in order to even out where your dollars are going. So if we look at RSP, which I don't recall that I've looked at before, we're going to see a little bit different of how these are all split up, right? We're looking at PayPal being 0.2699, Biotechna Corp, Zebra Technologies, Global Payments, which I do know. PayPal actually is up in our Webull portfolio for the investing challenge some way, somehow. We've apparently bought that thing low enough, and we didn't in other accounts, but that is what it is. GPN, they take a percentage off of every time that any credit card is swiped. They are the processing behind the scenes for Visa, MasterCard, American Express. They take a small transactional fee every time a card is swiped or entered. Expedia, DoorDash, IQ, VIA Holdings, Baxter, International Paper, Willis Towers, right? So the list is much, much different. It represents 0.2, almost 0.25% of the fund is split amongst all of these individual companies that are in the S&P 500. So a lot of different ways to look at it, right? And you can kind of come in here and do your homework. You can say, hey, what's the performance of RSP versus VOO? I'm sure you could throw it into any AI anymore and see which one works better for you. But like this one, we're looking at the growth of $10,000 over the past 10 years, right? So we're looking at what color is the orange? I'm just trying to see if that is RSP or if that's compared to VOO. Oh, sorry, it's right here. RSP is the green, or the purple, and it's 30,464, right? So if you put in $10,000 back 10 years ago, that $10,000 would now represent 30,464 in RSP. A large blend would be about 33,808. So it might have underperformed VOO simply because some of those larger tech companies have grown more than maybe some of the small or mid cap companies. So let's just kind of navigate over there. We're going to take a look at VOO, and this is kind of just a refresh. Kind of get other people caught up to speed. So if you've been here for a long time, it might be different than what you're looking for. But it kind of gives some people a bit of a catch-up period, right? So VOO has made more money over that same 10 years, right? That $10,000 back in 2016 would now be worth $40,603. So now you get to determine to yourself, what's next for the market, right? Do we think that small caps are going to do better? Do we think that mid caps are going to do better for the next 10 years? Well, rates are higher. We think that they might come down. but are the large companies, the AI monsters, are they going to keep just printing money, right? And I kind of lean that way. I kind of think that those large companies have the stranglehold on the market right now. I don't know how the broadening out looks, and I kind of feel like we saw some of that when it came to the market on Friday, right? We were looking at the Dow being up almost 1%. We're looking at NASDAQ being up only 0.43, S&P 500 being up 0.43. So not really the NASDAQ gaining that we have seen. We've seen other stocks kind of roll up. We saw Tesla and SoFi roll up nicely. Tesla has been kind of lagging behind. And now on Friday it was up about 5%. And that was on some robo-taxi news out in Vegas. I think about 5,000 robo-taxis got approved to be driving people around Las Vegas and Clark County. You're also looking at the Tesla semis going over to Europe to be debuted there. We kind of thought it was going to be a bigger deal here, and it really hasn't been. And I had to do an AI search as to how many Tesla semis were on the road, and it's only about 100. So there was a lot of hype about the fact of Tesla semis, the trucks, not conductors, right? Not semiconductors, being on the highways. And it was this big to do. Frito-Lay, I think Coca-Cola maybe adopted some. I think they're one and the same. So there was a lot of talk about the fact that Tesla semis were going to start taking over. This was probably also around the time when I want to say it was Biden was saying by 2035, we're going to be really implementing all EVs. I think the same thing was said in California. Now we're kind of backpedaling that. So it seemed like it was going to be the future, and then we backed up, and then we're kind of looking as to how we're going to move forward, right? So, and then you also had the talk of Elon Musk saying that SpaceX was potentially, and this was kind of just hearsay, SpaceX might have potentially looked to acquire Tesla. So the longer that he could keep the price of Tesla stock down, it gave SpaceX a better opportunity to be able to buy out Tesla and roll that into one company. For whatever reason, I'm not 100% sure. I'm sure it's some sort of tax structure, business structure, synergistic play between the two of them, which you would think would already be there with him being the owner of both. However, I'm not sure if that's going to happen or not. So it rolled up nicely. We're going to see what happens there. I think the robo taxis is probably one of the new things for Tesla that could go well. SpaceX, right? Let's take a look here. And I told you guys in the one teens I was trying to buy this, and that is what I did. So I don't have much. I probably have like $3,000 and then 2,500 in this account, and probably like 1,500 or 2,000 in the other account. So I'm trying to buy in this 110 to 117, 118 range. And then we had this kind of roll up about AI, about SpaceX trying to become a AI leading company that's making chips and kind of building out that side of the business, not simply just space exploration, not just rockets, but we're going to be looking at more than Starlink. We're going to get into the chip side of the business, right? So that's when we got up to about 146. And I told you guys, do not buy this on IPO. You're going to get crushed. And if you didn't buy it that first day, you did get crushed, right? It went up to 225. People thought it was going to go to 3, going to go to 4. This is going to be a $5 trillion business, and it's not. It simply just is not yet. Do I think it'll get there? Hard to say. I think it's got the potential to get there, and I like to see where it goes forward. I think that having the right engineers in the right spaces in order to get some groundbreaking movement going forward could really be beneficial long term. So I do want to have some funds here, but again, at what opportunity cost? So for me, this price point is down in like the 110 range, and you see plenty of guys or gals on YouTube or on wherever saying, hey, this is a buy at 80. I see people saying I'll buy every last share at 35 when you guys sell it all. I don't know that that's going to happen. I mean, maybe it does. If you think about a $1.9 trillion market cap, I mean, it could get down to $1 trillion cut this in half and be at what, like $68, and still $1 trillion for a company that just went public, that hasn't really built out their AI yet, that isn't really making money on the trailing 12 months. We're negative. I mean, we could see where it gets to. But then what happened, right? What happened from 148 or wherever we got, 146? Well, then the second lockup expiration happened, to where those early investors could sell off some of their shares, right? So there's a lot more shares out in the public now, and there wasn't as much demand. So that supply really rose really rapidly, and the demand did not catch up. So the fact that we are finding some footing around that IPO price of around 135 is strong. I still want to buy it lower, right? I still want to buy it lower. So we're going to see where this, I think there's 3 or 4 stages of lockup. And I think Elon's is next summer, about a year from the IPO date, is when he can start selling shares. So will he start taking some profits? Is he going to take some cash out of the business in order to, do whatever he's got to do? I know he's got a lot of his cash, or a lot of his wealth is tied up in these businesses, right? Between SpaceX, Tesla, and X, or formerly known as Twitter. He's got a lot of money there, right? So the opportunity cost for him is much different than what it is for us. So that's kind of what I'm getting at, is if I'm building my business, if I go buy, say, I don't know, 10 new lawnmowers, right? That means I can't build out some other side of my business, say, my systems or my office or my property or whatever it might be. So the opportunity cost is, yes, I can build more mowing crews, but can I build the infrastructure behind it to have everyone be as well efficient as we could, right? So maybe the right mix could have been buy 6 mowers and put a lot into the digital side of things, and have everyone mapped out properly, have everyone be a little bit more efficient when they're out in the field. So that would be the opportunity cost of me spending all the money on mowers and not any money on the infrastructure side. So we've got to take a look at that when we are spending our money on our portfolio just the same, right? So that is kind of what I wanted to get at. So I'm going to share a chat GPT. This is just what I put in: balanced portfolio for a 40-year-old with 20 years to retirement. Can I wait 20 years? I'm not sure. We'll have to figure that one out. We got their allocation is different than mine, right? This is just a kind of blueprint as to where we could potentially be, right? So they say 45% of your portfolio could be in the S&P 500 or the total market, right? So this could be in the RSP, into VOO, depending on if you want more exposure to those kind of high-flying growth stocks or tech stocks, or if you want a little bit more of a balance towards small and mid-cap. I'm guessing the more you put into an RSP that's equal weighted, the less you need in small and mid-cap. Just my 2 cents. International stocks, right? You could be simply looking at something like VXUS, right? So the Vanguard XUS, right? So they're cutting out the US out of the equation, and this would be something that you could potentially buy as well, right? So the expense ratios are really low on something like these. These are not managed funds. They are simply holding the however many best stocks that are not in the US, and where do they come from? What's the performance look like? Do you want to be in these, right? That's what we're looking at. So VXUS, we are looking at the purple. $10,000 invested this time 10 years ago is now worth $24,520. So hasn't made as much as VOO. Will that change? Potentially, right? Maybe the US is going to fall behind. Maybe Europe is going to be more of a growth driver. Maybe Africa is going to have a lot more growth down there. We aren't 100% certain, so we diversify. So the fact that we don't put all of our money into simply just into VOO, we can move some of our money into some international funds. That gives us a little bit of a broadening of, well, we don't really know what the next 10 years brings. Is Asia going to be a better market than the US in the next 10 years? Potentially, right? But if we're all in on only US stocks, do we have any exposure to these other markets? And that answer is kind of. I mean, like Amazon is linked to other economies. I'm not going to say that it's not. NVDA is linked to other economies. I'm not going to say that it's not. But you are missing out on those small, mid growth stocks that are in Asia that maybe are under the radar to you. So, for that standpoint, I can make a very strong argument to buy something like a VXUS that is, the stocks that aren't specifically just in the US. So, what is in this portfolio? Let's take a quick look here. So, when we're looking at this, if you follow along, I might be going too fast, but sorry, I'm kind of fluent in going through E-Trade anymore. So, this is just kind of how I navigate what I'm buying, right? So, TSM, Taiwan Semi, 4%. Samsung, ASML, so also in semis. SK Hynix in memory. Tencent is in China. I know they do a lot with web and gaming and things like that. I can't say that I know all of it. HSBC, is that a bank? I feel like it's a bank. Roche Holdings, I think that's medical. Royal Bank of Canada. Novartis is also medical. Alibaba is the Amazon of China. I still don't know how I feel about Alibaba. I can't really endorse it, right? So it's not something that I necessarily want to be in on that specific stock, but you can see that some of these are going to do well for you going forward, right? Not to say that every one of them is your top pick, but that is what you're going to get when you're buying one of these funds. You're going to be buying some stocks that you like, some stocks that you don't, some that are potentially overvalued, some that have a lot of room to run, but you are getting a basket of all the stocks, regardless if you like them or hate them, they're all in this individual fund, right? And it's also a set it and forget it. You could buy this or buy VOO weekly, not even look at it for the next 15, 20 years, and you'll be fine, right? You'll be fine. Pending some crazy World War III pandemic that is just going to be a problem for everyone, I think you're going to be fine, right? So the black swan events could crush the whole market in general, but even if you're in single stock exposure, you're probably still going to be crushed. So this is going to be likely safer than any single stock because not every single stock in the S&P 500 is going to zero tomorrow, right? You could have any stock that you own go down 70%. If it is a high spec growth stock that gets crushed, they could be out of business in a year. They could be out of business in 5 years, 10 years, but the S&P 500 as a whole is not going to go to zero, right? There's always going to be value there somewhere. And if it does, we've got bigger problems. That's how I always look at it. If the S&P 500 goes down 50%, we've got bigger problems than what your stock market portfolio is doing. So that again, that goes off a whole different tangent that we don't necessarily have to go down, but it is what it is, right? So what else are we looking at, right? If we're looking at international and we're looking at the S&P, well, then what do we want to do, right? So then, growth technology. We've looked at ARK funds before. They have not been performing well. One that I was just talking about with my dad, because I was trying to see, well, where do you want to be? How much homework do you want to do? And what stocks do you really not know much about? And that could be summed up in something like Quantum, which is QTUM. There are higher expense ratios here. But if you're going to look at the performance, I don't know that you're going to beat the performance of something like a QQQ or even something like a QTUM. So you're looking at $10,000 10 years ago would have turned into $61,488. So this is far and away the one that has performed the best over the past years of the stocks that we've looked at. Remember, RSP turned 10 to 30, VOO turned 10 to 40. And then the VXUS was like 26,000. So this one has got the biggest gains over the past 10 years. And I mean, we could look at something like a SPYG, which I've been trying to tell my boys who are 7 and 10. I try to put some money in there weekly. This is something you can buy that will give you good growth. and 10,000 turned into 49,429. So yeah, QQQ. What's the high growth one? That's the Nasdaq 100 QQQM. So this is the top 100, and that's only 26.5. So that might not be the one I'm thinking. QQQ might have returned more, 64,000. So QQQ and QTUM are in that top spot for the most growth over the past 10 years, right? But that doesn't tell us where we're going. That's only a rear view mirror as to what we've seen. So if you're buying this, can you expect your 10 grand to turn into another 60 grand in 10 years? No, please don't do that. Please don't simply think, well, I'm going to put all my money in QTUM. I'm going to neglect all other things. I'm going to neglect the VOO, the S&P, bonds, Bitcoin, anything else, because simply doing that would assume that these stocks are just going to continue running the way that they've been running, right? So when I'm looking at QTUM, you're going to probably get some overlap from QQQ, but this is going to be a lot more focused on quantum and not just simply those tech stocks, right? So Arcit Quantum, you're looking at Cloudflare, which is ticker NET, I want to say. Yeah, NET. Snowflake, RTX, which is going to be Raytheon. Actually, is it Raytheon anymore? It was Raytheon. Do they still go by that? Maybe it just goes by RTX post split. They split up that company, and I'm trying to think about what the ticker was before. I still think it was RTX, but it went by Raytheon. You're going to be looking at Horizon Quantum Holdings, NEC, Nutanix, Microsoft, Amazon. I'm sure there's some CoreWeave. There's some other stuff that's going to be mixed in here, but maybe you don't know a lot of these stocks, right? Maybe something like Nutanix or Cloudflare or Snowflake, ServiceNow, maybe that never crossed your radar. Maybe it did. Maybe you have a 10% position in that. But the point is if by buying this, you are buying this basket that has a lot of growth potential, especially with the next 5 years looking like it's going to be so focused on AI and quantum that maybe this is where you want to be. Maybe you don't want to have to do all the homework of, hey, what is Arcit? Do I want to be there? How much do I want to put there? And, what happens if Arcit goes belly up in 5 years? And, maybe Cloudflare was the pick that we should have had, but I put all my money in Arcit, and now I'm out of money. I'm out of the market. I don't like it. I don't want to be invested anymore. So the simple play would be buying a basket of these stocks that is managed. This one is actively managed. So you're going to be paying a little bit more on those management side fees, which are just going to be swept out of your account. You're not even going to know it. But yeah, the expense ratio is 0.4 compared to QQQ. Which is going to be less. Oh, actually, no, it's not. Sorry, QQQ is 0.68. So quantum, this is QQQI. This is not the right one. QQQ is going to be at 0.18. I thought it was less. And then VOO, like I said, is at 0.04. So that's 0.03. So even less, right? So you're going to be paying more for some of those higher growth ones. You're going to be paying more for actively managed versus just the index type fund that just you're going to manage it based on what's in the S&P 500. We're buying that. So there are some different fees associated with each of these investment strategies. So we go down the list, right? So yeah, then you're looking at small and mid cap. There's other ETFs for that. Bonds and treasuries. There's other ETFs for that, right? The one that I am slowly getting started in would be BND. And people say, well, if all you need is 4% drawdown every year in retirement, meaning you're taking 4% out, this is paying 4% or 4.63%. You could simply just have it here and just have your money. Well, this doesn't account for inflation. So the fact that you're taking 4%, this is giving 4%, it doesn't really even out. But you're also at that opportunity cost, right? If you have 5 million and it's all in bonds, yeah, you're gonna be just fine, right? You're making your 4%, and you're fine, right? You're not taking out 4% a year. If you are, you're living pretty lavishly. Yeah, I guess probably maybe average. Maybe it's less than I'm thinking. I'd have to do the math there. But say you had 10 million and you're taking out 4%, you're covered, right? You got enough there. It is what it is. But that assumes you already have that money in the bank. So if you're younger and you're still trying to build a portfolio, you probably don't want as much in bonds. That's like the rule of 100, rule of 120. Subtract your age, and then you can kind of figure out how much you want into bonds based on your age, based on your risk profile, how much you want to invest. We can take a look at that. I'll pull that up on ChatGPT next, and we'll try to refresh my memory as to what that rule of 120 is. But as you get closer to retirement, this is super safe, right? This is backed by all the bonds, right? And they're going to get paid out first. If a company goes belly up, well, hey, they still got to pay their debts off first before the shareholders, right? Shareholders aren't getting anything. People that own the debt are going to get paid before the shareholders. Shareholders can go bankrupt tomorrow. They ain't worried about it. They're worried about the debt that they have to pay off first. So when you're looking at this, it does make sense to get some more bonds into your portfolio as you get closer to retirement. It is a good way. And the bond market is bigger than the stock market. It just simply is, right? So that is another thing to consider as you're getting closer to retirement. This is a very, very, very small portion of my portfolio at this point, and it is something that I am trying to get better at, adding a little bit here when I can, when I should. I know that I should have more bonds, but they're just boring. They just bore me. So I don't spend a lot of time on this. I don't look at all the bonds. This is what I buy. And that makes it easier for me to think, well, this is my one bond fund. It covers the total bond market in one ETF. It's a choice fund. It's super cheap, 0.03. It just works, right? And you don't get a lot of fluctuation. So $72 to $75 over the past year. It's cheaper, which means you get more of a yield right now versus if it goes to 75, right? So that's what I got there. And then I'm looking at Bitcoin, right? We're looking at Bitcoin or alternatives, and they say about 5%. So I will say that this 10% probably is, they're probably right as to where it should be. I just don't think I need 10% of my portfolio in bonds at this given point in time. It's not a bad idea. It's just not for me yet. I would like to be a little bit more focused on growth for like the next 10 years, and I'll slowly start accumulating more and more bonds or dividend stocks. But it is not going to be for everyone. So if we look up the rule of 120 for stocks, so for a 40-year-old, right? 120 minus 40 gets you 80, right? And that says 80% should be in stocks, 20% should be in bonds or fixed income. I don't think that it's that high. I'm probably more like rule of 130, 135 maybe. I'm like 5% at this point. So it's different for everyone. A lot of people say it's a rule of 100. That's historically what it was. So saying that at this point, 40% of my portfolio should be bonds or fixed income, I don't agree with that at all. I think that is way too high. And I mean, maybe if you are a high net worth individual, maybe if you could retire at 40, maybe it should be. But I'm not there. So I still want the growth, and my portfolio mimics just how I tend to think. And that being said, I started very heavy in dividend stocks because that's kind of what I was raised thinking is dividends beats growth. And now I've positioned myself more growth, right? So I probably need to think about some more dividend type stocks. So if I'm doing that and say I just simply wanted to go with dividend plays, like where do you want to go? Well, SCHD comes to mind as some dividend names, right? So if I'm looking at SCHD, it's the Schwab US Dividend Equity ETF, right? So you're getting 3.25%. You're getting a basket of stocks. So rather than just buying UPS, Verizon, Altria, and pick Coca-Cola individually, you're buying the basket of them, and you're simply just putting your money right here, and you don't have to think about, oh well, I want 2% of my portfolio to be in Coke, I want 3% to be in UPS. You're simply just buying a predetermined basket of these individual stocks, right? So you're into companies like Abbott Labs, that's going to be in healthcare. You're in AMZN. You're in Merck, that's healthcare. You're in Coca-Cola, that's consumer staples. You're in United Health, that's going to, again, be tied to healthcare, obviously. You're into Home Depot, that's going to be into kind of consumer staples, right? If you need new plumbing, or if you need, your roof fixed, Home Depot. You're going to be into Procter and Gamble, that's going to be in healthcare and consumer staples. You're thinking paper towels, you're thinking, household goods. You're going to be in Chevron, right? So you're in a lot of these different companies that we've talked about before. But if you think they're all too boring, well, buy this. Buy, 5-10% of your portfolio into something like SCHD. You're getting a dividend, you're getting some growth, but then like you can put a little bit more into QQQ, right? You could be even on both of them. You could have QQQ, VOO, SCHD, and throw in a bond fund and call your portfolio good. And I don't think anyone in their right mind can argue with the fact that you're diversified, you have income, you have growth, and you have fixed income, right? So there's nothing at all wrong with this specific breakdown if you wanted to go with these different stocks. And some people think, well, SCHD, it's all well and good. The dividends mean nothing. It's only 3%. I'd rather have the 30% growth that Quantum or QQQ gave us year over year. But I mean, this is another way to balance out, what if your growth stocks don't work? What if AI or quantum doesn't really pan out the way we thought it was going to? Well, this is also another good way to get some dividends and get some growth. You're not going to get the growth with bonds. This is going to be like 1.5% less than you're going to get on the dividend side. But that 10 grand 10 years ago is 30, call it 33,000. Can we even look up what a bond BND portfolio performance would have done? It's pretty much right where it was, right? 10,000 10 years ago gets you to 11,429 today. Now that does not assume that your dividends or interest has been reinvested, I'm going to assume, over this time frame. So I'd have to do a little bit more of a dive on that. Now, it's not a bad way to go, but like I said, you're not getting the growth when you're looking at BND. And if you had a bad 10 years in the stock market, BND is going to keep being right here. It's going to just turn out that 4%. So it really does depend on the long term, what you want to do, where you want to be, how well diversified you are. If you looked at the BND during 99 or 2007, 2008, it's just going to continue paying this interest. Where other stocks, something like a QQQ or a Quantum during those times, not saying that Quantum was even around, I don't know when that fund started, it would have gotten destroyed. And you could have been looking at something that went down 40% in a year, which if you're in BND, you're not going to get that. If you're in SCHD, you're likely not going to get that drawdown. You're going to get maybe 10%, maybe 15%, but I don't think you're going to get the pull down that you would have gotten being overly exposed into QQQ, QTUM, QQQI or M, whatever ones we clicked on by accident. QQQI was the high income ETF. So maybe that's got more on the covered calls. Maybe that's paying more of a dividend because, yeah, it is saying that 10,000 10 years ago would have got you to 15,004. So I'm guessing this is going to be covered call related against the NASDAQ. That's probably going to pay you a higher dividend, which it does. It's a 14% yielder. And I only know that by sheer, I'm not going to say luck, but just experience in the market. I have never looked at QQQI to my knowledge. But when you look at something that's going to be a high income, it's going to be generally all in these dividends, and it's probably tied to covered calls. So you're not going to get the stock price appreciation. You're going to get it in dividends, and depending on what type of account you're holding this in. If you're in a brokerage account, you probably don't want this because you're getting hit with this dividend income yearly, and it might not be qualified. So you're probably going to be paying a lot more for this income. So if this is in a tax sheltered account, you're probably better off. But this is going to be fluctuating, and this is going to be tougher to manage, right? So, and I didn't even look at the charts, but if we look at like a QQQI and we go all, we're going to see probably some peaks and troughs here that might be a little bit too much of a roller coaster for some people. An all might not do it, but yeah, if you look at this going from 5 something down to, what was this, 416, and this was just in 2025. I mean, we can see that that's a pretty substantial 20-ish% drop. Or if we look, this is 2021, we probably have to look at more of like a 2020 to really get that. Can we find a 10-year on this? That's what I'm looking for right now. So the 10-year would give us that COVID drop. So yeah, if we take a look here, this is a 2020. We went from, now I can't get the prices, which doesn't help me. But you guys can see, and I think everyone was around and remembers how bad February and March of 2020 was, right? It looks small here, but we know it was substantial. And just the, oh, sorry, I got my little recording pop up in the way. So I can see it, right? So you guys could have saw it. I couldn't see it. So we went from 219 down to 190, and I don't think that gives us the full picture. So we can just agree to disagree there. I think we all know that COVID brought down the market like 30% in the course of maybe 6 weeks. And yeah, it rebounded quickly, but it was painful, right? So if you don't like those swings, simply being in a QQQ might not be for you. So again, opportunity cost. If we buy all Bitcoin and it does nothing, and we didn't buy any AI, this year looks pretty rough for us until now, when Bitcoin has been up 22% in the course of a week. But if we simply just bought Alibaba and thought, man, this is going to take off and it's going to be better and bigger than Amazon, I mean, we can take a look at the 10-year there and see just how poorly Alibaba went, right? So this is why I don't want to be strictly in one name. Or simply just tied to it, because if we look and you're, I'm trying to get everything to fit in one window here for me. If we look simply back here and we're like October of 2020, man, this thing was at 304. It's going to go to 600. And then we've spent all these years sub 100. And I mean, I had some. I know a guy that had a lot of Alibaba that he probably bought in like the 240 range. And he was like, man, I just can't wait for it to get north of 100 so I can sell off some of this. And that was like his pain tolerance, was like, if it gets to 100, I'm selling off some. Yeah, and it went to 178, but now we're down near 119. So this has been painful. Zoom has been painful. If you thought that that was going to be the future and we were never going back to the office, man, Zoom was a painful stock. Netflix has been rough. So simply buying one stock can be great, but then it also has that flip side of just trouncing your whole portfolio for years to come, right? If you're buying this during COVID and you're like, man, 478, man, Zoom is just the new thing, and then it just sits under 100 for all that time. Painful, right? Peloton. I mean, do I have to go through all these COVID darlings that remind you guys that these stocks just got demolished? I mean, Peloton was 151. And that's probably peak COVID time. Yeah, December 1 of 2020, man. Everyone was buying workout equipment. And now we're at a $5 valuation. I mean, I never got into the Peloton craze. One, because I know from going to gyms and seeing infomercials over the years of all the different exercise equipment that just is here and gone, that it's just not for me. I mean, you guys can remember all the Nordic Track and the Billy Blanks and the Tybo and P90X and everything else that has just been here and then just out, right? Like it's just all a fad. Peloton has more staying power, but you're also just trapped into peak greed of everyone thinking that it's going to be the new thing and the only way that people are ever going to work out again. And then you see what happens 5-6 years later, and this is just the end all be all of why you don't want just simple one stock in your portfolio, man. Because if you're buying up here and you're like, man, I was awesome, I got Peloton at 70 and it went to 150, I doubled in months, and now you held it too long, boy, man, I feel bad for you. So we do also need to think about taking stocks and taking some off the table, and that can be tough, and that's tough for me too. I mean, I pulled up the one that I think about regularly that I need to take some off of the table, and that is Micron. I keep selling covered calls on it, and I keep using it as a money printer for myself. We're at 966. My current covered call is at 1,050. The average price target is 1,559. Some way, somehow. Even the low side is at 1,100 with 13% of upside. I just feel like I'm greedy. I feel very greedy right now, but I also don't want to pay the tax man any more than I already have to this year. So I keep writing covered calls. I take 30% of that covered call. I put it into a 4% yield savings account on E-Trade, and I'm letting that money sit for paying the tax man. That is just my strategy. That's what I'm doing there. I know I have too much exposure to Micron, and that's why I'm telling you guys, if you're simply just into some of these ETFs, it is a much easier way to get invested, stay invested, and is a much easier way to get started, right? Do you have these 10x moves like you might have had in Micron? Probably not. Probably not, right? But it feels like a safe way to get going, because when you look at Micron and you're like, man, I should have bought back here. I should have bought when it was 94, or even going back further, I should have bought when it was 29. I'm happy that we bought here. I think we pretty much all but slammed the table saying, hey, this is what I am buying. I am buying this under 120. I mean, it went really well for us, but there are stocks that did not go well. So we've had some success. We've had some fails. We've had some flops. So it's not for everyone. A lot of the things that I said I was buying didn't go the way that we wanted. So I want you guys to just be aware that sometimes it's going to work. Other times it's not. So if that's not for you, ETFs are a great way to get going. Going back to what AI says, this simple, let's pull this back up, having this, where are we at? Having this type of breakout, 45% in the S&P, 15% in international, 15% in growth, 10% in small and mid, 10% in bonds, throw 5% in Bitcoin, set it and forget it. I don't know that you can really be upset at the end of the day. Your money is now not a commodity. Your money is now a tool, right? You're taking your money from a commodity where you just get it and spend it to now you're using your money as an investment strategy and a way to make more money, right? So instead of just simply spending your $5 at Starbucks, every time you do that, for a long time, I tried to do this. If I was spending any type of money that I didn't really need to spend, I made sure I could spend it and also invest the same amount. So if I'm buying a $100 pair of shoes, at the same time, I throw another $100 from my savings account or checking account into my investment accounts. And I think that's probably a great way for a lot of people to go. It really makes you stop and think of your money as not just a commodity, but as a tool. And I think that is probably one of the biggest switches that you can do that gets you from spending all that income to investing your income. And it really just kind of makes a switch in your mind as to, I need to think about long term and the short term, right? The commodity of I'm buying coffee, I'm buying shoes, I'm going to the movies. Now trying to translate that into what would future, 60-year-old me think of what I did when I was 30. And you're not going to remember the coffee. You're probably not going to remember that new pair of shoes. Yeah, maybe you remember some of the experiences. Maybe you remember some of the movies you went to see or the vacation you took. But I try to make that a balance, right? And I've said that before. We're at that barbell approach of growth and dividend, but we're also at that approach of where my money gets spent and where my money gets invested. So hopefully that gives you guys a little bit of insight as to maybe how you can better manage your money, how you can get started. If you know someone that is trying to get started, please share it with them. At this point, it's too late for me to restart. I don't want to sell off everything that's like a Micron that has 700-800% of gains. I don't want to. I don't want to have to restart. But if I were going to restart, if I had to restart, like I told you, I'm telling my 7 and 10-year-old boys that, hey, SpyG is a great way to go. That's and I say, hey, what do you guys want to buy? You want to buy Roblox? You want to spend the money on Roblox? Or you want to buy SpyG? And they both kind of just respond to me, oh, I'm buying more SpyG. Mom, I bought SpyG at 115 or whatever I spent it on. So Roblox is another here and gone to me. I think it's got potential, but I don't know how long that staying power is of a company like Roblox. So I don't want them to be putting thousands of dollars into Roblox over the next 5 years. And then, hey, Roblox is no longer the thing. We should have been buying Sony. We should have been buying PlayStation stock. So for me, it makes it really hard to go ahead and say, hey, yeah, Roblox is the play for them, that when they need the money, when they're 20, 25 to maybe buy a house or start a business, buy a car, that money will be there. Versus Roblox, where it feels like too much exposure to something that might not be staying around. So think about that opportunity cost. Think about, does this company have that staying power? Is Peloton at 150 where you want to put your money? No, I just can't see it. Versus something like an ETF that is going to have that staying power that you can simply just buy every week and let it grow for you. And again, that's the name of the podcast. That's why we're here. We want our money to grow. We don't want it to be a commodity. And I've seen too many people use their money. That paycheck is gone by Monday. I've seen it. I don't like it. I want people to be a little bit better off. So that's why I'm kind of sharing this all with you. SpyG is simple, man. It's simple. And sometimes simple investing is the best type of investing. So that's what I got for you guys. If you like SpyG, this is what you're buying, right? We went over all of it. Micron, Google's, Broadcom, which I'm in Broadcom. I added more individual shares. But fortunately or unfortunately, my portfolio that I self-manage myself has all of these names minus Berkshire. And a lot of my portfolio is in these positions. And it probably would have been easier to just start buying something like this 10 years ago. But that is not what I've done. So my portfolio mimics these without buying them evenly every week. I buy them when I think each of them is down. And I still think NVIDIA and Broadcom are down significantly, or not even down significantly. I still think that NVIDIA has some of the best growth potential and is undervalued currently. So I would buy more of that for myself. I still really like the outlook here. I really like where this company's going. I like that for the past 14 years, they've outperformed on quarterly reports. I like that we've got 40% of upside here. I think that is comfortable. I really do. And I know it's kind of like, hitting the same drum every week. And I think that Broadcom in the 360 range is a great investment. 37% of upside there versus something like an Apple, where I don't think that you have the amount of upside, and the analysts don't think that you have the amount of upside either. So if you do want to stay focused on the market, you can look at each of these individual ETFs and pick out the ones that you really do like. And sometimes that's easier on something like a VOO or a SPY-G. Maybe not as easy with a quantum, that there are a lot of smaller companies, but you can kind of pick and choose and say, hey, of this list of the top 10 stocks, what do I want to buy that has the most growth potential in the next 12 months? Apple's a great company, but I think NVIDIA is a better buy. Broadcom is a better buy than, I don't know. I don't know that I want to throw Tesla under the bus, but maybe Broadcom's a better buy than Netflix, maybe. I think Broadcom's probably got a quicker turnaround than what Netflix is going to have, but I don't want to throw Netflix under the bus either because I'm building out a position there. All right, what are we buying this week? I know I'm kind of just ranting at this point. SoFi, I talked about the fact that SoFi is above 19. Well, it was above 19. Now we're at 18.91. Not as much upside there. CRM, I still like the fact of software as a service. It has kind of come back up. We were much lower. I think we were sub 160. Yeah, I think we got down to like 160 in June. I like where it's at. There's not as much upside from here, so that's probably off the table for me. Adobe, I still don't know what to think about Adobe. It does have downside. I'm trying to kind of rationalize my position here. I don't even have much of this. I sold out of it earlier. AMD, man, I still love AMD. So SoFi's out. Salesforce is out for this week. Adobe, no. AMD, I like Adobe at 473. I really do. 36% of upside. I can't argue that. I can't argue NVIDIA. That's on the list. Microsoft is probably already above where I want to be buying it. Beginning of the year was at 473. It dipped down into the threes. Now we're back at 483, but 16% of upside. So it's kind of had this roller coaster of a ride when you look at the past year. Down to like 350, up to 450, down to 80, and then we hit, call it 500 here. Then we're kind of stuck up here. So do we form another higher low in like the 420, 430 range before breaking out higher? I mean, that's kind of what it's looking like it wants to do here. It looks like we might be a little overextended, maybe a little overbought. Maybe we trend back down to that 440-ish range, 430 range, and then shoot higher. So I wouldn't be buying it here. I would wait for a pullback after this monumental run that we're looking at from 380 up to 500. And I would be buying on the way down. So I'm not buying that here. Amazon, AMZN, I still really love Amazon. And I said earlier this summer that 4 years from now, I think Amazon is the one stock that I would comfortably put a lot of money in if I had to have one stock in my portfolio and I'd be comfortable with it. I would probably say Amazon, 30% of upside. I have a lot of this already. I don't really know that I'm looking to just keep on adding here. I do really like the stock. Netflix, I still really like Netflix, but it is kind of stagnant, right? It doesn't really have the upside. And the other thing, well, we have GE Vernova on the list. Netflix is about 20%. GEV is probably limited at this point. Oh, no, it's not. 33%. Man, that's kind of a surprise. And that has been just a stellar performance over the past year for GEV. Beginning of the year was 679. Now we're at 956. I thought it might have been too much of a monumental run. So when you're looking at the names that are on the Investing Challenge portfolio buy list for this year, and how I was saying you can pick from that top 10 list of an ETF, I think that's kind of where we're at right here. This is basically picking from the stocks of the year. AMD, NVIDIA, GEV are probably your most amount of upside. And then the kind of wild card here was Bitcoin. We could simply just buy Bitcoin, right? We could go on Webull, where we do buy the Investing Challenge portfolio, and we could simply just buy Bitcoin. Bitcoin being at like 77, 78,000. It has had that 20% run in a week. Do we want to buy it on a Monday? I don't know. I will probably just go ahead and buy another $100 of Bitcoin and throw it in the investing challenge portfolio. And I'm going to say we're going to buy AMD. I think that's probably the best bet. I still think that we are in the beginning innings of what AMD is going to do. People are going to get scared away from this trailing 12-month PE of 119. This episode is getting a little bit long here. So I'm going to look at Refinitiv real quick. We're going to wrap it up after this. It is rated as a buy, 5-year return of 350%. You guys know I'm going to look at this PEG ratio, and we're going to see just where we're at here. I'm looking at a company with around 28% of upside from 46 different analysts. We're looking at earnings going up significantly from 417 in 25 to 767 in 2026 to $15.61 of earnings per share in 2027. So that is over a triple in 2 years. That's massive, and these chips are just going to keep flying off shelves, right? So annual revenue increases 47% this year and another 109% by the end of next year. So yeah, revenue increase over the past, or from 25 to the end of 27 is 156.8%. That's massive. And I still don't think that the market has caught up to this one yet. So if the PEG ratio mimics what I think we're going to see, yes, the PE is high. We know why it's high because it's that future numbers and the growth that they're churning out. So I'm thinking this PEG ratio is cheap, right? It is at a 0.7. So that PE is high, but the growth rate is higher. So you are getting this stock at a discount. And that assumes that AI spend does not drop, and I don't see that it's going to, right? We're looking at a very high price to sales, but we're also looking at a company with substantial, stellar, all the good words that we want to use when it comes to their future, right? So AMD, Let It Grow Investing Challenge portfolio purchase for Monday, August 24th, $200 going into AMD. And that's what I got for you guys this week. Please make sure you like, subscribe, and share. Thanks for sticking around. This is the longest episode I've done in quite some time at just over an hour. And I appreciate your time. And hopefully you guys learned something. Please make sure, again, to like, subscribe, and share. Thank you, guys. Take care.